Hello everyone, welcome back to my YouTube channel. My name is Ayu Enda Lestari, you can call me Ayu. I'm a student of Mercubuana University majoring in accounting. In this video, I will explain about profit, profitability, and future trend. Okay, let's go straight to the video. Happy watching! Profitability. Profitability is the possibility of making a profit or earning a profit. According to Indonesian dictionary, profitability is a measure of the company's ability to generate profits over a certain period of time. According to Bank Indonesia, profitability is the ability of a company to generate profits during a certain period at a certain level of sales, assets, and share capital. The profitability of a company can be assessed in various ways depending on the profits and assets or capital that will be compared with one another. Understanding profitability according to expert. According R. Agus Sartono, profitability is the company's ability to earn profits in relation to sales, total assets, and own capital. According Cashmere, profitability ratio is a ratio to assess the company's ability to seek profits. According Susan Irawati, profit ratios or profitability ratios are ratios used to measure the efficiency of the use of company assets or the ability of a company to generate profit during a certain period, usually semi-annual, quarterly, and others, to see the company's ability to operate efficiently. Types of profitability ratios. Gross profit margin. Gross profit margin is a profitability ratio to assess the percentage of gross profits to revenue generated from sales. Gross profit, which is affected by the cash flow statement, describes the amount of profit earned by the company taking into account the cost used to produce product or services. Gross profit margin formula is gross profit divided by income profit multiplied by 100%. Net profit margin. Net profit margin or net profit margin is a profitability ratio to assess the percentage of net profit earned after deducting taxes to income earned from sales. This net profit margin is also known as the profit margin ratio. This ratio measures net profit after tax on sales. The higher the net profit margin, the better the operations of a company. Net profit margin formula is net profit after tax divided by sales. Return on asset ratio. The rate of return on assets is a profitability ratio to assess the percentage of profit obtained by the company related to research or total assets so that the efficiency of a company in managing its assets can be seen from the percentage of this ratio. Return on asset formula is net profit divided by total assets. Return on equity ratio. Return on equity ratio or ROE is a profitability ratio to assess the company's ability to generate profits from the investment of the company's shareholders expressed as a percentage. ROE is calculated from the company's income to the capital invested by the company's owners, common stockholders, and preferred stockholders. Return on equity shows how successfully the company managed its capital or net worth, so that the level of profit is measured by the investment of the capital owners or company shareholders. Return on equity formula is net profit after tax divided by shareholders' equity. Return on sales ratio. Return on sales is a profitability ratio that displays the company's profit level after payment of production variable costs such as worker wage, raw materials, and others, before deducting tax and interest. This ratio shows the level of profit earned from each rupiah of sales, which is also called operating margin or operating income margin. Return on sales formula is profit before tax and interest divided by sales multiplied by 100%. Return on capital employed. Return on capital employed is a profitability ratio that measures the company's profit from the capital used in the form of a percentage. The capital in question is the equity of a company plus non-current liabilities or total assets minus current liabilities. ROCE reflects the efficiency and profitability of the company's capital or investment. ROCE formula is profit before tax and interest divided by working capital. Or you can also use the formula ROCE is profit before tax and interest divided by total assets minus liabilities. Return on investments. Return on investment is a profitability ratio calculated from net income after deducting taxes to total assets. Return on investment is useful for measuring the company's overall ability to generate profits against the total assets available to the company. The higher this ratio means the better the condition of a company. ROI formula is return on investment minus initial investment divided by investment multiplied by 100%. Earning per share. Earning per share is a profitability ratio that assesses the level of ability per share in generate profits for the company. Company management, common shareholder, and prospective shareholder are very concerned about earning per share because it is an indicator of the company's success. EPS formula is net income after tax minus preferred stock dividend divided by number of shares outstanding. It is useful as an assessment benchmark for stock trader to decide whether a company's stock is worth buying or not. To help evaluate the company's performance as well as see the development of company profits from time to time. Knowing the amount of net profit after tax with own capital. And assessing the productivity of the company through all the funds used, both loan capital and own capital. Future trend. What is new in the accounting world? Ever-evolving technology and a trend toward automation of repetitive accounting tasks are some of the most existing developments in the accounting industry. Some of the processes that are being automated include approval workflows, bank reconciliation, journal entries, intercompany consolidations, revenue recognitions, lease accounting, and depreciations. While there are many accounting functions that can be automated, there is a lack of understanding of the technologies and a lack of research to implement them. But those that take the leap are reaping the benefits. Some 17% of companies that have automated more than one-fourth of their accounting functions report moderate or substantial ROI. Role of artificial intelligence. Across industries, there are consensus that AI can and will have a significant impact on finance and accounting. Companies are using AI and robotic process automations to automate mundane, highly repeatable tasks, allowing accountants to focus their time on higher impact and higher value activities. Accounting firm EY, for example, has applied AI to the analysis of lease contract to make it easier to capture information quickly on commencement date, amount to be paid, termination or renewal options, and allow the finance professional to spend more time on making decisions with the data instead of looking for it. Accounting software. For RPA to be successful, transactional data needs to be standardized and merged from multiple sources in multiple formats, also known as harmonizing. Harmonizations can involve bringing together structured, semi-structured, and unstructured data within a single system. AI needs vast amount of data to be effective. And above all, the outputs of all enabling technologies need to be trusted by the accountant. That's where accounting software comes in.